All right, we're live. James Wilson, James Ng with Old Capital here today. So we've sort of gone on this road of looking at deals that are on the market. We sort of underwrote a couple deals, and then do you remember what we did last week, James?
Which live stream we did last week?
Yeah, what live stream did we do? So we sort of looked at, I think earlier in the
Syndication
month.
Pro.
Yeah. So we sort of looked through deals that were on the market in DFW. And then we sort of went through underwriting, and then we also went through sort of how to structure your team. And so today we're going to really be jumping on. Joy, thanks for jumping on the live stream. First one on, I appreciate it. So we're gonna. All right. So let's say you make a couple offers on deals, and now it's time to. You've actually got to close the deal, right? You can't. You send in the money to the title company. Now it's time to close the deal. So today we're going to be talking about what it's going to take to go through the loan process. So I'm going to share my screen, and if you need any of the slides, just reach out to us for the slides, and we'll be able to get them to you. So, all right. So maybe while we're pulling up the slides, let us know sort of where you're dialing in from. Both James and I are here in Dallas, Texas, and so let us know where you're coming in from in the comments. It's always interesting, and sometimes we'll ask you questions about what's going on in that market as well. So. All right, let's jump in here.
Yeah, I'm here in Uptown. You're up in Frisco.
Yeah.
It's pretty nice in Texas this time of year.
Oh, yeah, this is as good as it gets in Texas.
I think we're about 75 degrees today, maybe 80. It's really nice out.
All right, can you see that all right?
So we got Salt Lake City, Kansas City, Atlanta, San Francisco Bay.
Nice. All right.
Vancouver. Oh, James Livingstone. Shout out.
James, I've been loving your stuff on LinkedIn. Appreciate you jumping on. All right, let's jump into this loan process. Can you see that all right?
Yes.
Okay, perfect. So let's go. So here is sort of the roadmap that we're going to go through. It definitely starts with getting a loan term sheet from us, a mortgage broker. Then you're going to go through best and final. And then once that sort of PSA or loan application is signed, you're going to have lender inspections. You're going to have to provide them a long list of checklist items that we're going to go through. And then we're going to get into underwriting. So this number 4, from number 4 to 5, do you see that I made that a little bit longer, James?
Yeah, it looks a little like a slippery slope on step 4 to 5.
Yeah, so in loan underwriting, so I was a loan underwriter for like 10 years at GE. And, that part, everybody's always asking, like, is the loan approved? Is the loan approved? And so we're going to talk about what that process is actually like and what the underwriter is actually doing during that point in time. And then we'll get
because there's a lot of steps that go in between, weeks 1 and 5 to get all that stuff in. And then you're underwriting. And then the whole time you're thinking, wait, the loan's not even approved yet?
Yeah,
we've done a lot of work already here.
Yeah, so you're going through a lot of the process, and then once you lock the interest rate, and then we'll be able to close the deal. So let's jump in and start from the beginning. So I guess before we jump into that, like, people are like, how are these guys on the screen qualified to even talk about loans? So in 2022, we did 1.2 billion. And they all closed. So I think we're pretty good. 127 loans, 13,000 units in 2022. Q1 of this year, about 160 million closed across the board, mostly Fannie and Freddie stuff that you see on the sheet here. And then my prior background was I was the loan underwriter for GE Capital, and then originated about 1.5 billion in multifamily loans over the last 8 years. And then we'll do a quick plug for the conference, our once a year event. If you want to see us live in person, come down to Dallas for the Old Capital Conference. We'll have 500 of our closest friends at that event. So come on out to that event. All right. So let's start off with, so we're going to start up in the top left, loan term sheet and best and final. So let's start with the loan term sheet. James, maybe give people an idea of what is the loan term sheet and why do you need it?
Yeah, usually we like to work with borrowers probably, 30 days out before they submit their LOI, just to kind of underwrite the deal. They'll go tour the deal with the broker. Sometimes we go out there with them. just get a feel for where, interest rates are. We give them different loan options. We'll do a Fannie Mae loan option, Freddie Mac loan option, and then depending on if it's a larger deal, you probably don't want to go recourse bank. You probably want to get a couple bridge quotes. But if it's a smaller deal, under 5 million, then you probably want a bank quote as well. So we give a term sheet with a bunch of different quotes so that the borrower can put it in their underwriting model and kind of see which debt works the best.
So what do you need? So what do you need from, like, a lot of people are asking, like, oh, I want to quote on this, I want to quote on this. What do you actually need from the borrower?
Yeah, you got it right there. The T12, trailing 12 financial statement, the rent roll lets you know the occupancy. So, like for an agency loan, for example, it needs to be stabilized, which means 90% occupied for the last 90 days. So the rent roll will have all that information, occupancy information. And the OM has, property address, number of units, details about the property. So you can kind of tell, okay, where's the location? Is it a good location? Is it a bad location? Kind of that supporting details. And then from there, we can kind of just put a quote together and see, just from talking to all the lenders and quoting a lot of deals, we kind of know where stuff's at most of the day.
Yeah. So the deal that we're going to go through today is really like a $20 million, $21 million loan. And it's actually a refinance that we did in the last, 3 or 4 months. And so on this one, we got the T12 and rent roll from the borrower and had it sized up here. So the NOI was close to 1.8 million. And then the loan was this was back in, I think, Q3, Q4 of last year. So 10-year hadn't come up as much as we thought, or as much as it's moved. So we were a little bit tighter here on the rate at 4.5, but so they had sized the loan at about 21 million, 22 million. So they're going to give you initial guidance on what they think based on the debt service coverage of what it's going to be. So most deals are not sort of LTV constrained. They're more debt service coverage constrained right now. So, all right, let's go to the next slide here. So, everybody always asks, James, like, how come I don't get more leverage on these deals from Fannie and Freddie? So maybe talk about how they size some of these deals up.
Yeah, everyone's always looking for a little bit more juice on the deals, but yeah, they're debt coverage constrained. So, debt service coverage ratio, you hear DSCR a lot. The best way I can describe it is that if you have $1 million in NOI, the most amount of loan payment you can afford is $800,000. Like whatever the interest rate is, whatever, doesn't matter. $800,000 is the most loan payment that they can go. So then they work backwards. If the interest rate is high, the amount of loan that they can give you is lower. So if the interest rate is lower, they can give you a higher loan amount, but it's a 30-year amortization based on that $800,000 is kind of what they can give you. And the reason I say $800,000 on $1 million NOI is because that's a 1.25
debt service coverage.
Debt service, yeah. So if you multiply 1.25 by 800,000, you get $1 million, which basically says your income is 25% higher than your loan payment. It's kind of just a safeguard so you don't default on your loan.
Okay, so on this loan, for example, so they're sizing up the NOI. So they're going to take T3 on your net rental and annualize that. They're going to take T12 on your other income. They're going to do pro forma expenses. So that's pro forma means what the borrower is going to run the property at, with the exception of the T12 utilities. They're going to use the T12. And then the NOI has got to be divided by your debt service, has to be greater than 125. So on this example, the debt payment is, I think, 1328 over here, and the NOI is 1.66 that the lender's using. And so that allows you to get a loan of about 21.8 million on this deal. So when you send in this information, so you send us the T12 rent roll, OM, all that stuff, then we'll actually size the loan up based on these projections, T3, T12, pro forma, and then give you a term sheet that basically says, all right, here's your fixed rate options, floating options, your bank loan options. So this was already on a floating rate loan. And so they were really looking to go to a fixed rate. And so they ended up moving to, so that's what we quoted on this particular deal.
Yeah, someone
So
had a good question about the amortization on the debt service coverage ratio.
okay.
So they do size to fully amortizing. They'll give you interest only, but the actual loan is with P&I payments. If that makes
Yeah.
sense.
Yeah. So this, so in this question, so this 1328 is not, so if it was just the interest, right? So if it was 21,840 and at just the interest of 4.5, the payment would only be $982,000. And then, but with the principal payment in there of it totals 1.328. So the principal payment on this one was Got here. All right, about 345,000 is the principal payment for that first year. So yeah, so it's on a P&I. Okay. All right. So we get the loan term sheet and we send it back to the borrower. The borrower, if it's a refi, it's up to the borrower. Is it time to go right now? Do they want to refi? Does it hit sort of the proceeds that they want to be at? But then I also wanted to talk about, during the acquisition phase, you're going to get what's called a best and final on a lot of deals. And so, James, explain what the best and final is.
Yeah, best and final, and then head to head sometimes. So when we have a call for offers date. A year ago, you would get 30 offers on any given property from different buyer groups. So then, to kind of weed out the process and try to get the best, five to 10 buyers, or, it's really depending on what the broker comes up with or who the broker thinks are the best candidates. You'll have what's a best and final. And then they'll say, give us your best offer, sharpen the pencils a little bit, see where you can get reduce some expenses or where you think get some more NOI to get a little bit higher of a price. And then they'll pick a winner based on, it's not always who bids the highest, but most cases it is. They'll consult with the seller and see who's the best pick for the deal. And then, they might have two finalists and go head to head. But now it's, there's a lot less offers on properties, which is actually a good time for new people to get into the business because you're going to have less competition than you did a year ago. And that competition might come back if they start cutting rates. So what are you seeing for best and final these days?
Yeah, I mean, that's definitely right in terms of, there's less competition. There are best and finals still. And, what a lot of times people get hung up on is just the price. But it's all of these items that the broker is going to ask you for, right? So let's say due diligence process, like how long are you going to be at the property? Are you doing a lease audit? Are you doing physical inspection? Who are you using for that process? Is it my guy? Is it a contractor? Is it somebody we know in the market? So number one is due diligence process. Number two is equity, right? So do you have the money sitting in the bank account already? Like, is it already raised? Is the funds already ready to go? Or do you have to go out and raise it? Do you have to syndicate the money? So that's number two is equity. Financing is number three, right? So are you going to use Fannie or Freddie? Are you going to use a bridge loan? Are you going to use a bank loan? Is it already approved? How
Are
long
you
is it gonna
qualified to
take?
get that agency loan?
Yeah, are you qualified to get that agency loan? That's exactly right. And then this is, brokers will actually ask you about your underwriting, right? They'll say, hey, can you use, what do you use for property tax? What do you use for insurance? What do you use for this? Because if you can't show that you can underwrite the deal, then they're probably not going to give you the deal, right? So expenses and then your rehab budget. So a lot of times people will ask, the broker will ask for your rehab budget because they'll say like, well, I have $1 million rehab budget. Okay. And then you might come back after the due diligence process and say, actually, there was this, sidewalk that was messed up and can you guys fix that? Well, we got $1 million rehab budget. Like maybe, so you have to be careful what you put on there. And then they're going to look at legal counsel as well. So, everybody wants to be known as a deal maker, not a deal killer. So who you using for legal counsel can be key. And then also how many deals have you closed in this market, right? So how many deals have you closed in this market? Because if you haven't closed anything in this market, people don't know you, it's going to be harder. But if you can point to 10 deals in DFW that you closed, then it's pretty easy. to award that person. So the broker and seller at the end of this choose one person to go on a dance with, because it could be a 60, 90, 180 day dance. So they want to choose the right person to take to the dance with. All right. All right. So let's say you get awarded the deal. All right. Now we're gonna kick off this process. So now we're gonna go back to the map here. So we do the loan term sheet. We got best and final. We get awarded the deal. PSA signed. We're going forward now. So let's get the first week. All right. What are we doing the first week, James?
We're trying to get a loan app. We're trying to get the best financing for the deal, get the loan app signed, wire the earnest money to the title company, and that kind of solidifies the process, kicks it off,
Okay.
gives the loan or the person giving the money, gives them the money to get an underwriter on the deal and start looking at it, start doing the due diligence.
Okay, so on this one, you can see on the right-hand side, they did a loan app at about $21.5 million. I think this was a step-down prepay. So it was a step-down prepay at 245 over 10-year. And then it had 5 years interest only, and it was a refi. And so if you're doing the acquisition, you might not submit the loan application right away. You might wait maybe, a week or 2 weeks while you're doing your due diligence. But if it's a refi, it's already your property, then you're pretty much starting day one, right? And do they need to send in any money on the loan app, James, or is it will the lender start working for free at that point?
No, you usually need to wire some sort of earnest money. I think, depending on the deal size, probably like 25,000.
Yeah, I mean, what we've seen on deposits, I mean, Freddie SBL will be probably the cheapest, probably around $10,000, 10 to 15,000. Fannie Mae will be around 20,000, and then Freddie Mac will be around 30 to 40,000, just depending on the loan size. And then bridge loans will probably be about 50,000. So it's going to go up.
Get pretty expensive, pretty quick.
All right, so we send in, we do sort of our initial loan application, send in the deposit, and now the lenders on the clock now. They're ready to start going for us. So, all right, what happens in week 2?
So then once we get the application going, signed up, they're going to start ordering third-party reports for the property. So that's going to be a survey, and that can take anywhere from 2 to 4 weeks. And when
so the buyer actually does the survey.
Yeah.
So lender, sorry, keep going on the lender.
Okay, lender, they'll order PCA, construction assessment to make sure that property's in good physical condition, or if it needs any immediate repairs. They'll also order an environmental study, make sure that there's no oil leaks under the property or anything hazardous having to do with the property. They call it a phase 1. And then if hopefully you don't need a phase 2, that's probably not a good sign. But if you've already if it's a refi, then you'd probably be good. Trying to think what else. What are the third-party reports?
Yeah, those are the main ones.
Yeah,
engineering,
survey,
environmental.
Okay.
Yeah, so while they're engaging the third parties, some of the key items that you're going to want to send in are your org chart. So just showing the ownership of the entity, that's going to be the borrower, borrower counsel. So that's your legal counsel, your insurance agent, and then also get the title commitment going. If it's a acquisition, they're also going to ask for your rehab budget in year 1 pro forma. So that's just how you're going to run the property, and then how much rehab you're going to do on the property as well. So, so that most of the third parties take about 2 weeks, 2 to 3 weeks. So, we want to get them engaged as soon as you get the loan application in. And then, our job now is really on the due diligence side. So let's go over. So you're going to get a long list from the lender of all the due diligence items. I hit sort of the high level ones here. James, maybe go through the checklist and what's some of the things that maybe sometimes people have questions on the due diligence checklist that maybe they're not familiar with. But some of it's pretty straightforward.
Yeah, I think a lot of times the lender will ask for and this will be in a Dropbox from the seller. A lot of historical stuff that you don't necessarily see in the T12 and rent roll, like some of the capex they've done. Uh, any, I think you got engineering, environmental, service contracts. They'll want to see, who you have contracts with, like laundry, and other different services on the property. They want to see, delinquency reports, collections reports. So yeah, they'll ask for a lot of that property stuff, and then I'm trying to think if there's any other questions they would ask about um, the property. Yeah, that's
No,
the
I mean
that's the property, and then obviously you have the sponsorship as well. That's kind of the stuff that we get up front, like the PFS to see if the person's qualified. So we'll have a lot of that information that we can give to the lender, but you got SREO, the scheduled real estate, that shows you what the borrower has done in the past. It kind of shows their resume. You're gonna need the resume as well. Bank statements. Everyone's that's signing on the loan is gonna have to sign a credit authorization, which basically tells the lender they can start doing credit checks on them. And then you got operating agreements there. So yeah, you want to see the operating agreement with the management company that they ask for.
all right. Yeah, let us know if you guys have any questions on some of these items that the lender is going to require. Whether it's the due diligence on the property. So this top section, this is really going to come from the seller or you if it's a refi. Sponsorship due diligence, this is your PFS, REO, bank statements. They're checking liquidity. They're going to ask for the actual bank statements. They're going to run your credit. In terms of management due diligence, they're going to look at your third party manager. If what their experience is in that market. And then to wrap up, they're going to look at insurance, termite inspections, utility bills, just make sure that everything cross checks and makes sense with each other. So,
yeah, that's
right.
A lot of that stuff is what we facilitate during the whole transaction.
So we'll help you put it together.
We'll kick off all the third parties and make sure that you get quotes for, the survey, and make sure that the title companies or you get the commitment from the title company, make sure the lender is ordering stuff. We just like push on all areas to make sure that you have a successful transaction.
All right. So let's say week 4. So while we're submitting all the information, the third parties will start coming back. So we get the appraisal back. So when the appraisal is like 150 pages, what 3 pages matter, I guess, in that 150 pages?
What they value the property at.
All right, so we got the value of the property right here. That's 1 checkbox.
So you got to make sure that you're loaning on the right amount.
Yeah. So
you don't want
max
your amount to be less than what the property appraised for, or you don't want the property appraised for less than what the loan is.
Yeah. So let's go back one slide here. So we got a question from our buddy Anselmo who came out last week. What would make a lender change who you would want to use for a third-party property management company?
I actually had a deal that they requested not to use someone. So
yeah, so if a lender maybe has a bad experience with a previous management company, or maybe that management company just doesn't have any units in that market, it's sort of one of those chicken or the egg, what comes first. Unfortunately, you need a lot of units in a market, and then Fannie and Freddie feel a little bit more comfortable that those properties are performing. And so a lot of times they'll ask for not only the property management company's resume, they'll also ask for their portfolio and the occupancy of those properties, right? So if they see in a market like Dallas, you've got, 10 properties, but all of them are running at 85%, and the market occupancy is 90, 95, then that lender is going to say, like, what's the story there, right? Obviously, if you can tell them the story, that helps. But anything else on that, James?
no, I think they do their due diligence on the management companies, just like they do the sponsors. So got to have experience. Experience is key in this game.
All right. Let's go. So appraisal. So what else? What else do you guys look for in the appraisal? Maybe let us know in the comments what you guys look for in the appraisal. All right, so the value came in at 34 million. Okay, so it's a $21 million loan divided by 34. So we're at like 60% levered. So that was good. All right, what else do you look for in the appraisal?
Looks like we got the comps, comparable sales.
Comparable sales to get to a cap rate. Okay. And then
what their NOI is on the what they underwrote for NOI.
Yeah, so the NOI is probably the big thing. So they're going to look really hard at sort of your T12 and sort of compare that to pro forma. And so on this one, they got to about 1.8 million on NOI, and so that was pretty much in line with the NOI that was coming in on our term sheet from the beginning and loan application. So that's key because the lender is going to usually underwrite to the highest of the budget, the borrower budget, the T12, or the pro forma. So
yeah, we're pretty sharp with the debt quotes because we do so much business with Fannie Mae and Freddie Mac that we're pretty close. So when we see somebody come from outside and it's way off, we're like, I don't know where you got that quote, but if it's not close to where we got it, because we got the model down pretty good, it's going to be, I would call it suspect.
Yeah, sometimes someone could come in and say, well, yeah, we can give you a $25 million loan on the refi. And we're going to be like, well, show us how you get to that NOI, right? Then maybe they're using like $300 a unit on insurance and not adjusting taxes, stuff like that. So, all right. So we get the appraisal back. What about engineering, environmental? What are we looking for on there?
So the engineering report is going to tell you if you need immediate repairs. And those immediate repairs you have to do immediately.
Okay. So this is sort of the top right, immediate repairs. We got some landscaping in here. We got sometimes if they have like, city violations or, parking violations, anything like that, they'll make you fix that sort of before closing. So that was about 6,700. So they'll escrow that at 125 or 125%. Make sure you do it in the first, 60 to 90 days. And then what else are they looking for on the engineering report?
A deferred maintenance that you might have to do as part of the CapEx within, was it first year?
So the immediate repairs is stuff that, all right, you need to get done in the first 90 days or so. And I'll make this a little bit bigger. This is sort of harder to see. But this is like a table that they'll put for like the first 10 to 12 years, depending on the loan. And it just basically outlines, all right, what is the cost of carpet, flooring, all your major systems. And then at the bottom, they're going to like take that number and add it up, total it up for the whole 12 years, divide that by the number of units, divide it by the number of years. And then that actually determines your replacement reserve. So most of the time we're using about 250 a door, maybe 300 a door in replacement reserves. So you times that by the number of units, and that's what you get on. So that's what we're also going to be looking for on the engineering report is not only the immediate repairs, but the replacement reserve on engineering. And then environmental. We're looking for the shortest environmental report that we can find. We usually go to one page, the conclusion, and see, all right, there's no history or no recognized environmental conditions or recs. And once we see that, then we're good to go. We've got the clear for takeoff here. So
so with the CapEx reserves, do they hold that back each loan payment or
the replacement reserve?
Yeah, the replacement reserves.
Yeah, the replacement reserve. So let's just make up an easy number or try to make up an easy number. Let's say 250 a unit times 100 units, right? That's 25,000. And then you divide that by 12. So it's about 2,083 a month. So you make that payment along with your regular P&I payment, along with your tax and insurance payment. So that goes into an escrow. Okay. Yeah, it goes into an escrow every month. And then, at the end of the year, you have 25,000. But along the way, you can draw for any CapEx items from the lender. And so So now we got the engineering back, we got environmental back, we got the appraisal back, and hopefully by this time, this usually, we're a month into the process now, and you want all your due diligence in, right? So all these items that we outlined here, you want all those items in, so that the appraiser, sorry, not the appraiser, the underwriter can really
Yeah.
start doing their stuff. So week 4, 4.5, week 5, all the stuff is submitted into the lender. And then now my buddy Steve Harvey says you're clear to close. Just kidding, still in underwriting. So a lot of people, I was an underwriter for a long time. Everyone's like, what takes so long with underwriting? Like, what are you guys doing? I thought this deal was approved. So I want to get some comments from the audience on this one. So I put like a white sheet here. So potential issues that could come up in loan underwriting. So let's help me out in the comments. What do you think could be potential issues that would be coming up here on the loan underwriting? James, you want to kick us off? Maybe just start rattling off a couple. I didn't prepare you for this one, but let's start firing here.
This one hits close to home, and I think JG said it. Appraisal.
All right. So appraisal.
Boom.
Is
appraisal
short
or
okay. Yeah. Appraisal is lower than expected.
So I had a deal that was 65% LTV, based on a certain valuation. The valuation came in 30-40% lower, and so the loan got cut by quite a bit, to the point where the borrower just said it's not even worth doing.
Right. So
that's a potential issue.
Yeah. So when you look at the loan term sheet, a lot of times you're looking at 125 debt service coverage, but also they're going to put like a max LTV on some of these, and so the appraisal comes in lower than expected, and that's going to lower your loan amount. All right. Next issue.
Background checks.
Background checks. All right. So Brent, appreciate you jumping on. So background or credit searches. So what do you search for on these, James? What do people? What's the lender looking for here on the background credit search?
Any criminal or bankruptcy?
Okay, bankruptcy, foreclosures. Yeah, criminal, bankruptcy, foreclosures, maybe any litigation.
Yeah, any pending investigations.
Yeah, pending litigation. And then also, I mean, just straight Google searches, right? Like if the lender Googles your property or Googles your, then yeah, I mean, it's going to be an issue. All right. And then let's see, Brent also chimed in here also with just PFS. So yeah,
so maybe if they just screenshotted a number and it's got nothing to back it up.
Yeah, personal financial statement. And then I would say, so usually we don't run into issues on the personal financial statement. It's usually the bank statements. So you might be showing like $1 million liquidity, and then you get the bank statements. It shows like 200,000, and they're like, "Where's the rest of the money?" So, on a lot of these, so this is a $20 million loan, right? So $20 million loan. So how much liquidity do you have to show on a $20 million loan?
$2 million.
Yeah, 10% of the loan amount on the liquidity. So you need to show $2 million. So they're going to actually get bank statements from you, the lender's underwriter. So this can, sometimes this can be a little sensitive. People don't want to give them, but for Fannie and Freddie, that's essentially, they're going to want that.
So we got evictions. And all right, so murders at the property.
All right, so property issues. So let's say crime at the property. Let's go a little bit broader. Anything else at the property that they would be looking for that you can think of, James?
Yeah, usually at least my experience was that if there was a shooting on the property, the lender passed on the deal because they Googled it before. So if you got this far, Maybe they do find something, they start digging a little deeper, but definitely could be an issue.
Okay, so crime at the property, shooting on the property. Um,
KP drops out last minute.
okay, so this could be. I mean, so let's say
Experienced borrower.
let's say you have a key principal. So this is someone signing on the loan, and they are typically adding what net worth, liquidity,
Experience.
experience, multifamily experience.
So let's say they have, done 3 full cycle deals with Fannie Mae, and they're the KP, and the person that has the deal under contract has no Fannie Mae deals. This is a Fannie Mae loan, and they say, you know what, I think I'm out.
So this is also coming up. Like this came up on a deal yesterday. Is the I'll call it the bad borrower list. So a check on Fannie Mae. That's sort of like the do not fly list or do not lend list. If you're on that list for whatever reason, then you're not going to be able to get a loan from Fannie Mae. So you might have to sell the property sooner rather than later. We also had going back to the property. So fires. What happens with a fire? Do you know how do we handle? How does the lender typically handle that? There's a fire on the property. Let's say while it's under contract. Any ideas or?
I did a refinance on a property that had 16 units burned down. We still closed. It took a long time going back and forth to go over like, okay, what's the insurance covering? What's the insurance not covering? Is the insurance covering the new borrower, or is it covering the existing borrower? And does that existing borrower have some sort of agreement to pay the new buyer?
Okay, and then did the lender just do what, like immediate repair holdback or what? Remember? But usually they'll just look at it as like, okay, yeah, the money might be there, might not be there, but yeah, they're gonna want some sort of.
Yeah,
they just want to make sure the work is done. Okay.
Yeah, it's a pretty big ordeal with the fire damage. It's not an easy process.
So Lisa asked about. I'm not sure if you're talking about people, applicants who are applying for the loan or tenants in terms of FIFA. But I would say if you have any dirty laundry that you want to hang out, I would hang it out at the very beginning, back in week 1. Hang out all the dirty laundry in week 1 and let everyone know up front that, I have, if you have any of these items or if there's any issues at the property, the sooner we know about it, the better. The sooner the lender's underwriter knows about it, the better. Because then you can sort of mitigate around it. You can set up stuff around it. You can make sure the right person's on the loan and not that person's on the loan.
Yeah, because I mean, a lot of these issues do pop up, and I think we've worked through some of them with some people just to kind of smooth it over with the lender and provide mitigation plans to still help the borrower close.
Yeah, it's always easier if we know up front what the issue is, so we can sort of address it. All right, so let's see, I flipped over. So I had sort of pre-thought about some of these items. So it looks like we hit most of these on the guarantor side. So credit score, usually we're going to want a credit score, I think above, let's call it 650. I can't remember the exact score that Fannie wants, but let's say over 650. They're not going to want to see bankruptcy, litigation, foreclosure. We're going to have to address those. One thing that is probably new is sort of on the schedule of real estate. So SREO, schedule of real estate. They're going to look at maturities. So your loan maturities on your investments. And
we got 10 bridge loans coming due in 2023.
10 bridge loans coming through. Like that liquidity that we talked about, that $2 million, it doesn't like transfer on each deal. Like that $2 million can only be used one time, right? So, and then foreign guarantor. So talk about foreign guarantors, James. What do they typically want on foreign guarantors compared to just someone, born here in the U.S.?
Usually they want some sort of partnership with somebody in the U.S. or some sort of entity that was formed in the U.S. and then
Okay.
money in a U.S. bank account.
And their
I'm not
requirements.
exactly sure the percentages, but I know you can't just be a complete foreign buyer. You got to have some sort of uh, access into the United States.
Yeah, so yeah, if you live outside the US and you're buying your deal by yourself, I mean, that is definitely going to be harder. You're probably going to do lower leverage. You're probably going to be maybe 60% levered, maybe a 135, 140 cover instead of 125. And then they're going to want this is where the third party property management is going to come in, which we're going to talk about is going to be more and more important. So, all right. And they usually want double net worth, double liquidity. So if you just had, one times the net worth of the loan amount, they're going to want 2x on you. So
What about the folks from Canada? I know there's a couple of people from Canada that
Canada is still a foreign country. You are still not part of the U.S. as much as we love our Canadians. You are still so it's the same thing. Like it's the same requirements. They're gonna want double net worth, double liquidity if you're buying your own deal. But if you partner with someone else, it usually you can get like a waiver, and usually we can still get foreign guarantors on the deal. All right, let's go into property. So we talked about crime on the property. We haven't touched on tenant concentration. You want to touch on tenant concentration at the property?
Yeah, so 40% or more can't be the same tenant concentration. So if it's like a university or a military base or trying to think of what else, maybe just all Costco employees.
I would love to have all Costco employees. No, I'm just kidding.
No, I'm
So
kidding. Yeah.
student, employer, market. Like we saw a deal. It was probably 2021, I think. So like before, really, like this was in like the heyday of multifamily. A deal like got foreclosed on, and you're like, what? Why did the deal get foreclosed on? It was because every single property in that market went to like 60% occupancy. And the reason was it was heavily concentrated in energy, and that market just everyone
So
left. There was no
40% of
reason.
the employees were oil and gas.
No, it's probably higher. It's probably like 100. Right? So some people were still sticking around waiting for the oil prices to go up, and then maybe they would come back to work. But then as soon as, if there's no jobs, people aren't living in the middle of nowhere, right?
Odessa.
And yeah, I mean, some of these markets where there's a big concentration, you got to make hay while the sun's shining. So lower LTV for sure. If there's any concentration, or they just might not do it, right?
Mm-hmm.
And another thing I would look at is probably the floodplain at the property. Make sure that you don't need flood insurance at the property. Property management. Most people that we work with are probably going to need third-party property management. So just make sure they have some good, good experience in that market. And then we touched on appraisal, engineering. This is probably one also on engineering that we see come up sometimes is really just the immediate repairs can come in high for things like the roof or windows. I mean, at some point on your 1960s property or 70s property, at some point you've got to change the windows. Like the windows are 60 years old. At some point, you've got to change the windows. Take a look at the roof, make sure the roof is good. Those are some of the big things. I mean, the wiring for sure. Whether it's aluminum wiring or copper wiring, most of the stuff probably
Stab
60,
lock
70.
panels.
Stab block panels, the panels. Those will be immediate repairs that you're going to have to do for older properties. And then environmental, we touched on. If there's any sort of issues with, oil leaks or, contaminated water or something for that property, then you're going to have to need a phase 2 on that. So as you can see, just on how long we've talked about the potential issues that can come up, like this can like derail the train, right? So like if we go back up here, like from week 4 to week 5, it might take some iterations here of coming through. You might have to take a turn here and then and this is a little bit longer and take another turn before you get the loan approval. So,
Loan's
anything
not
else?
approved yet.
Yeah. We're still going. So
We're
week
45
4.
minutes in.
So, anything else on loan underwriting? So at the same time, that, let's say you're doing an acquisition, at the same time that you are the lender is sort of working through all these things, the underwriter is working through, going back and forth with questions, then you're raising equity for this deal. Like, we forgot about that. Like, oh yeah, I'm buying it for 34 million. This is a $20 million loan. I still got to come up with $15 million. So while you're answering questions with us, going through underwriting, you're actually out there raising equity as well. So you got to make sure the equity is getting raised at the same time. All right. Week 5, we made it. Loan approval. You made it this far. So we get the approval from the lender. This can come from Fannie Mae, Freddie Mac. It could come from the bridge lender. And this is going to give you your final term. So on this particular deal, they ended up going with a little bit shorter term. They went with a 7-year term. They got 2 years of IO, and they went with yield maintenance. And then it ended up being about 21.6 million is the maximum until they locked the rate. So once we got the approval, we sort of ordered all the made sure all the searches were done, made sure all the operating agreements were all signed up, all the LPs is signed.
What's the interest rate?
Interest rate? Well, we're not there yet. You're jumping ahead of me here. So you gotta go to lock the rate, right? So once you get the commitment, you're gonna have to send in. So at the beginning, do you remember? So let's say we sent in $40,000 for the third parties, for legal, for all those people to get going. Now you gotta lock the rate. So here is where it differs based on the majority of the time. Once you get the loan commitment, you're going to have to send in a good faith deposit of anywhere from 1 to 2% of the loan amount. So this one, I think, was 2%. So 2% of 20 million, so $400,000. So you better be sure.
Hopefully that equity raise is going well.
Yeah, before you send in that good faith deposit, make sure that your equity is good to go, that you're ready to go. So get the loan commitment signed, send in a good faith deposit, make sure the insurance is all good to go, and then you're able to lock the rate. So
this is a good thing for limited partners to ask too on deals, is if the borrower has locked the rate yet, because I've seen deals where, in the very beginning they say, oh, we got a low rate. They advertise the low rate, but they never locked it. And then the 10-year could run up to 4%, 5%.
Yeah, and that's going to drive. So once you lock this rate, that's going to drive your final loan amount. You remember we talked about the debt service coverage from the very beginning.
Yeah, based on the NOI, you're restricted on how much debt service payments you can get, and so the interest rate is going to drive that total loan amount.
So I would say, so Freddie SBL is when you sign the loan application, they will hold your rate for 35 days. So you've got to make sure that you get all your stuff in, get it submitted on time, and they'll hold that rate. So that's Freddie Mac SBL. They don't require any additional money in terms of good faith deposit. But Fannie Mae, Freddie Mac, I would say smaller deals, let's say under $6 million, you probably only need 1% for good faith deposit. For larger deals, they're going to want 2%. So 2% is essentially going non-refundable. And if you don't close this loan for whatever reason, you can't raise the equity, or you can't, for some reason, you don't close the deal, this money is gone. So good faith deposit, and then you're able to lock the rate. I'm trying to think. And in bridge loans, most of the bridge loans are floating rate. So you're not going to ever lock the rate. So you're not having to worry about it. This is on fixed rate deals. All right. Week 7. All right. We're rounding the corner here, closing out the deal. So we usually put together what's called like sources and uses. This is really going to drive like sort of where all the money's coming in and where it's going out to. So here we have the final loan amount up here, the 21.6. We put in 25,000 for the loan application. We put in 2% of the loan amount. So this is actually refunded back at close, the 2%. And then, so the amount of cash out for the borrower on this one, in this example, was 500,000. They used that money to pay off the existing loan. They had to put up some escrows for insurance and taxes, replacement reserve. They paid the lender a 1% origination, and then legal and title fees. So this all goes through title. What are you seeing? Any other things on the settlement statement that people sometimes get confused about, or
I think if you're not familiar with it, it can get kind of complicated, but just
Okay.
make sure that you know which credits you're getting. You can
Okay.
you can ask us. We kind of build one of these out in addition to the lender, just to, and we kind of go conservative. So what the number that we come up with is going to be, you're going to need less money to actually close. So we work with the borrower on these, and we'll go over it for an hour, 2 hours, and go line by line and make sure that you're getting the right credits, and then making sure that the expenses or the sources are correct. Sometimes you'll get, depending on what day of the month you close, you might get some credits on security deposits and rents collected. So that's a source you might get.
Yeah, I would. Yeah, I would make sure. I would sort of. We can send you just sort of a template for sources and uses. Give you some examples. I mean, we see a lot of statements, a lot of title company statements, just by doing a lot of these loans, and so we have a pretty good idea of what's coming in. And so what I would do is build it out in your head first, and then look at the title company's settlement statement and make sure it matches up and what's different, and compare and contrast. When you look at the title companies, sometimes it's a little bit hard to see everything that's in there. So make sure you have that built in.
Yeah,
And I
and then the
mean,
title's got all their different articles of fees, but they're pretty standard across the board. I don't think you can get one title company paying less than another title company, right? It's
right.
kind of standard in Texas, anyways. I think in like other states, it might benefit you to kind of compete on title companies, but here it's more if the title company can close, if they get it done.
Yeah, if they close and they're responsive, then yeah,
Because
that's a good thing.
not all title companies are created equal.
Absolutely. So we sort of have made it to the end, into the close of the deal, down the roadmap. So we went from loan term sheet, best and final, through the loan application process, the lender inspections. We went through underwriting, had a couple turns through there, and got the deal approved, locked the interest rate, and closed the deal. So, is there, for the people who are on, if there's any questions, comments on the process, let us know in the comments. If you have any questions, we can definitely go back to any slides here and talk through any of them. And Lisa had a good point here on, also sort of when we were talking about the underwriting piece, back here in terms of concentrations, making sure that you don't have a lease to like maybe one employer, or even like an Airbnb provider. I know we've seen that before, where maybe you just do like a master lease for 10 units to an Airbnb guy, and he sort of does his Airbnb stuff. That sometimes will be a red flag for the lender, because lenders want sort of a diversified tenant rent roll, and not just like one guy decides to leave and everything's gone. So
Yeah, and Fannie Mae and Freddie Mac are government agencies, so they kind of have a mission of providing affordable housing or housing to people, not investors per se.
right, right. All right. So I think that pretty much took us through the loan process. I guess, do you want to touch on what we're seeing in the market just on the financing side right now? Here's just sort of our standard checklist. Let's maybe go through. You want to start on the bank loans?
Yeah, not seeing too much banking activity with all the banking crises going on. I think there was a good chart in, I think it was New York Times, they had, amount of bank failures in '08, and then the volume of, I think it was less banks, or maybe it was the same, but same amount of money defaulted with the banks. So we're kind of in a similar situation with banks, but there are still some. I think some of the Texas banks local that we work with are really good. They're strong. But yeah, prime rate's still 8%. I think you're going live this week with JP Conklin, right?
JP Conklin on Thursday. We're going to be talking about what the Fed has to say about the market.
Yeah. So likely, I think it's like 90% are saying it's going to be a 25 basis point hike. So prime rate will jump up, but yeah, anywhere from 7.5, 8% interest rate on a bank loan, and I think they're going to be similar sizing to that 1.25 debt service coverage ratio, just to be conservative.
Yeah, on these bank loans, I think the main thing would also be just sort of how much of their deposits, like a lot of these bank runs have been on where a lot of the deposits were not or they were over 250,000 of the FDIC insurance. And so a lot of the bankers that we've talked to here in Texas, I mean, yeah, they're worried about it, but they're more concerned if their deposits are like only concentrated with certain people, and those people all of a sudden pick up and move their deposits to JP Morgan or some of the larger banks. So, all right, let's go to maybe Freddie Mac, SBL next.
Yeah, so the agency loans are really the shining spot in multifamily right now. The interest rates are 5.5%, give or take. I think the 10-year is hovering around 3.5%. So Freddie SBL is going to be between 5.5, 6%. Right now it's probably like 5.75. They do have a lower, like you said, they have the lower application fee, and you can lock up front with that loan product. So it's a great first time investor loan, and it kind of makes sense with the interest rate where it's at. So it's definitely a good one for minimum 1 million, maximum 7.5 million. So it's a good first starter deal for someone.
On the Freddie Mac SBL.
Yeah, Freddie Mac
Absolutely.
SBL.
Okay. Let's go maybe to conventional Freddie and Fannie right now.
Yeah, so similar. I mean, they all size to the 1.25 DSCR, right? So the loan amount is going to be pretty uniform across the board on what you can get. Obviously, with the Freddie SBL has a little bit higher interest rates, you're going to get a little bit less loan amount. But Freddie Mac, Fannie Mae are going to be between 5.25, 5.75%, depending on the term. So if you go shorter term, 5-7 year, you might get a little bit higher of an interest rate on that higher end. And then if you go 10 or 12, you get a little bit lower spread over that 10-year to help you out. But yeah, same thing with the 1.25 DSCR. Freddie Mac minimum loan amount 7.5 million and up, and there's a lot of floaters for Freddie Mac that get done, and that's a nice aspect because it has that lower spread versus a bridge loan. The spread can be 2.5%, where the spread on a bridge loan is going to be 4.5, and those have been widening. I haven't really quoted too many bridge deals yet, or a lot this year. Yeah, just because the bridge loans have been 8, 9, 10%, and the cap rates are still so expensive. They don't really make sense on deals right now.
Yeah, I mean, we've seen I would say a couple comments on Freddie Mac and Fannie Mae. I definitely see them getting a little bit more aggressive as the year goes on. They got to hit 75 billion. They're a long ways away from 75 billion. And so we're seeing them get a little bit more aggressive, sometimes sizing off of, instead of maybe 35-year AM, they're going to 35, or sorry, instead of 30-year AM, going to 35-year AM on the debt service coverage. And then maybe even giving like full term IO on some of these deals as well. And then on the non-recourse bridge, yeah, you just got to really make sure that if you take a bridge right now, that you have the the upside in the rents, right? Because you're going to take 70% leverage at 8-9%, and then you're going to have to pay that off, right? And you have to pay off the
bridge is almost like a hard money loan at this point. It's like you got to get in there, get the NOI up as fast as possible, and then refi out into an agency. I think the days of trying to see how high you can bid on a property using bridge loan is kind of over, at least temporarily.
Okay. So we had Tyler jump in here. We'll jump back for a second. You want to touch on, I think, the loan term sheet size. So I think he's talking about the sizing, which is probably where we get most of the questions. You want to touch on this slide for him again one more time?
Yeah,
For
so the
Tyler?
loan term sheet, we're basically putting out different the last sheet that we just went over. We'll look at the deal and say, okay, is it a Freddie SBL and a bank quote because it's a smaller deal, and these are the two options you should go with, or maybe a Fannie Mae, or is it a larger deal? We'll give you a Fannie Mae, Freddie Mac floater, and a couple bridge options, and that's kind of the term sheet. We size it kind of how we see it. We give pretty good advice on which loan option you should go with based on your experience, your PFS, and we kind of look at the big picture. And how we do that is we usually take the T3 net rental income, so the last 3 months, and annualize it. So if property is trending down, that might be less than the T12. If it's trending up, it might be more. And then we take T12 expenses, and then we do some pro forma like taxes and insurance based on insurance quote. Like a lot of things that have been killing deals right now is taxes are really high and insurance is really high. So that's hurting the NOI a lot. So it's getting less loan amount on some of the agency stuff. But yeah, that's pretty much how we size deals and give quotes out all the time.
All right. Let us know if that answers your question, Tyler. We had another question come in here. Have you heard of any discounts from Fannie and Freddie for borrowers borrowing $200 million a year? So along that, like Fannie and Freddie have, so there's a no fly list, and then there's also a we want you to fly every week list. And
Premier
so
1000.
so there's what's called like select sponsor. So people who have done a large amount of transactions with Fannie or Freddie, and they will usually get either more IO or lower spreads from Fannie and Freddie in order to stay competitive. So we have seen that, and so it would be for people who have done a large amount of loan volume with those two agencies, though. All right.
Any other questions out there?
Well, yeah, if you have any more questions, definitely put it in the chat. We appreciate everyone jumping on. Please like the video, subscribe to the broadcast, subscribe to the channels that you're watching on, and then we will be back next Tuesday. I'm not sure what exactly we're going to be covering, but we will let you know once we figure it out for next Tuesday. But we appreciate you jumping on. Hopefully answered all the questions that you had on the loan process. If you want the deck, send us an email. We'll be able to send you the deck. And any questions, let us know.
Awesome. Thanks. We'll see you guys next week.
All right. See you guys.